Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're going to talk about the big, beautiful bill. We've been trying to do this episode pretty much since the bill passed, but held off a little bit because we were hoping that some of the implications of the bill for bankers, credit unions, and their customers specifically would start to flush their way out, just how they're going to handle some of these things within the bill and some of the other executive orders that are going around the country. But today we have with us John Doherty from Wolf & Company. And John has some insights that I thought we might be able to use, or you might be able to use as you think about conversations you might want to have with your clients. So without further ado, let's get to Bank Talk. Okay, welcome back to Bank Talk. I have with me John Doherty. John is a principal at Wolf & Company. John, thank you for joining us on Bank Talk.
Hey, Charlie. Great to be here. Thanks for having me. I was kind of excited when Rich reached out to see if I'd be a member of the podcast here. I've never been on a podcast, so I'm kind of excited to get started.
Excellent. Well, so John, if you could just give us a couple of minutes on either your background, Wolf's, in case they're not familiar with Wolf & Company. What do you do for a living? What space do you live in?
Yeah, Wolf has been around a long, long time. The firm started in 1911. We've always had a significant financial institution audit and tax practice, more what I refer to as traditional services on the external audit and tax preparation compliance work. Over the last, I'd say, 25 years or so, we've certainly increased our penetration into the financial institution space. And in addition to the traditional audit and tax, we also do a significant level of consulting services between internal audit, compliance, and information technology services as well. Always trying to stay ahead of the game and most relevant for our clients. So more recently, we've put a significant focus on working with clients in the digital assets and artificial intelligence spaces to help folks begin their journey down those roads of continuing to evolve the financial institutions that they're working with. Personally, I started here in 1997. It's kind of crazy to think that it's been that long. But I also worked at another firm before Wolf & Company that specialized in internal audit for financial institutions. And along the way, I was also a controller of a community bank for 2 years as well. So all told, been in the banking industry space for 30 years, exclusively working with financial institutions, generally in the external audit space.
Oh, excellent. You know what we're talking about here. It's not like
Yes.
we just pulled you off the street or found the janitor or something. That's great.
I could fake my way through it.
Okay, excellent. Well, the reason, John, that as you know, we're getting together here, I thought it would be interesting to spend just a couple of minutes and get your perspective on the big, beautiful bill and maybe some of the other things that are going on with executive orders recently. As you know, we would have probably preferred, would have been a little more timely to have done this a few months ago, but some of the stuff I think had to simmer a little and people had to get an understanding of what it meant, where it was going. So if you're good with it, let's start with the big, beautiful bill, the BBB. Probably is not what they're calling it, but let's call it that. And let's start with the implications, because there was a lot that came into that, short of having our listeners read 870 pages. What do bankers, credit unions have to think about as it relates to their internal, what's going on internally with them? Because we're going to cover that. And then after that, we'll cover how it might affect their clients and things they might be able to talk to their bank clients about. So let's jump back to the banks themselves. What can you pick out the top few things that you think bankers might be interested in as it comes to this bill?
Yeah, definitely. There's some really good provisions within the bill for financial institutions. I wouldn't say any of them are independently any sort of silver bullet for a bank, but I think most of the provisions are all geared towards promoting growth and capital investment, not just for banks, but for individuals as well as corporations, and really a significant weight towards doing some things here domestically versus relying on foreign operations or anything along those lines. So, the bill was signed into law on July 4th. Interesting that Trump certainly likes to charade
Leverage.
the dates, and you know he,
Sure.
you know what he's thinking, right? And I actually went back and looked at his original press conference as part of preparation for this podcast, and he was touting that the goal was 7 million jobs to be added, 15% decrease in individual taxes, which would result in a $13,000 increase in take-home pay for a lot of the individual filers, if you will. I think when you start looking into the detail, there is a lot of great provisions here. Some of them are making permanent some of the original Trump tax cuts back in 2017 permanent that were scheduled to phase out. So I think ultimately for a lot of the banks, it will give them a little more certainty as they look at their budgets over the next few years, for sure.
And their tax filings. Yeah. So let me stop you on that one, because I think that was, to me, one of the bigger ones they were trying to get through was to make sure that they extended. They were expiring at the end of 25. Do I have that right, or 24?
Yeah, certain of them that just like every government provision for taxes, some expire at certainly different times throughout. So like some of the bigger ones were like bonus depreciation. That's basically effective immediately, but that was scheduled to phase out to 0% in 2027. In 2025, it was going to be a 40% allowance for bonus depreciation. Yeah, exactly.
Gotcha.
And same thing with Section 179. There was some phase outs scheduled, but they actually increased the Section 179 expensing to $2.5 million, which was certainly helpful for a lot of small businesses and financial institutions as well.
And what was the 179 again? What the 2.5 million was what?
Section 179 really allows folks to accelerate depreciation on equipment that they purchased during the year, whereas bonus depreciation is more for qualifying property.
Yeah, gotcha. Okay.
For institutions, for financial institutions, certainly this is really helpful for scheduling when they're getting. It's really a timing issue for most financial institutions, so they're really trying to predict what their budgets are going to look like over the next couple of years and when they should be putting things in service and that sort of thing. A lot of banks are managing state taxes along with federal taxes, so there's a lot of moving parts, and having certainty in some of these numbers is always helpful.
Yeah, so that would be in, again, now, as we talked about, right, our space is in the computer side of the world, but if you're talking about equipment depreciation, it could be anything from your computer systems to your printers to whatever you have inside the branch, your teller stations, all that type of stuff intra branch, right?
Basically, it's all basically hard assets, we'll call them.
Yeah, gotcha. Okay, all right, and so that one may be more relevant at some point for their customers, if their customers are manufacturers or somebody who's got heavier equipment needs. People are doing leasing, all those kind of things. I would imagine that is a much bigger impact for some of their customers as well, right?
100% on point. I think for financial institutions, most of this is really timing related. Financial institutions generally have the cash to pay their bills, if you will, their income tax bills each year. So you're talking about a timing difference, whereas small businesses can tend to struggle with their cash needs. So if I'm laying out the cash for a piece of equipment or a piece of property this year, I may not have the same level of cash flows to make my tax payments if these things are deferred. So it's really helpful for a cash flow management standpoint.
Yeah, gotcha. Okay. All right. Anything else on any other provisions in there you think might specifically affect bankers in running their operations?
Yeah, I think there are a couple of things in here that are helpful depending on the institutions. There's some qualifications to exclude interest income on agricultural loans. Okay. So a bank doesn't have to include interest income on a percentage of of agricultural interest income they receive. So
Okay.
that's a nice one for those in the agricultural space. There's certainly some more reporting requirements under 1099, which is going to be a little bit more painful. Excuse me, 1098s for banks that we'll talk a little bit on the customer side of auto loans, interest deductions, but banks are going to have to enhance their systems to provide reporting to their customers on auto loan interest. So it's not all
Little
great
upside.
news in here, right?
Yeah.
And there are
Okay.
some tweaks to the charitable contribution requirements and some enhancements for investments in qualified opportunity zones and low income housing tax credits that certainly a lot of the financial institutions tend to purchase those credits as part of their overall tax rate management. So to the extent there's more funds, if you will, going into those tax credit programs, banks can be beneficiaries of some of those
Okay.
programs.
So
And the other
if
one,
you're a purchaser of tax credits, did it get better or worse in general? Did
well,
it become you could use them faster? Use
yeah,
them
I don't think it's going to. I think it's going to enhance that. Maybe there's going to be more available to be purchased,
more available. Okay, gotcha.
more availability to some of those tax credit programs. And the one thing that's a little yet to be seen that could be pretty significant for a lot of financial institutions is some of the decreased funding of the Consumer Finance Protection Bureau from, their operating budget basically just got cut in half. So there are a lot of the compliance requirements that financial institutions
Yeah.
need to abide by. So in essence, they're the overseer of compliance regulations,
Yep.
and their budget is being cut in half. Which it's not specific how they're going to decrease their budget and where they're going to focus their time at this point yet. But I think it's another mantra for the Trump administration is less compliance costs for companies.
Yeah, and I think as we've talked to bankers in the past, if you listen to the banker forums or what have you, everybody's happy about that one, and maybe not because it's more regulation, maybe because it's just a little less directed regulation, right? Like it was seeming under the Biden administration that some of the direction was getting, it was government pushing business, and I think the feeling maybe under Trump might be let's let business do their thing and just make sure they don't get themselves in trouble.
Yeah, it seems like it's a slow degradation of folks getting out of business lines that just aren't as profitable because the compliance costs become overpowering. I remember talking to a banker. Wow, this is a while ago. This is probably we'll say 10 to 12 years ago, and one of the bankers I was talking to said they had 1.5 compliance folks for every lender they had on staff, which just sounds mind blowing, doesn't it?
Oh, yeah, it sure does. I mean, unless you're in marijuana banking or something, right? Like some of that is there's a lot of regulations around, kind of Fed conflicting with the states and all that. So in which case, yeah, you might need some compliance people to make sure you don't get yourself in trouble there. But
Yeah.
just regular, doing banking as a banker, that's insane. That means that they don't have the ability to grow the business because they're throwing people in maintenance more or less, right? For lack of a better.
Exactly. And when you're talking on the loan side as well as the deposit side, you got Bank Secrecy Act and all, the litany of different compliance regulations that a financial institution has to follow.
Yeah. Now, oddly, all right, and this is a side note, but I'm listening to a book on. I do a lot of books on tape because I seem to be in the car a lot. But the book that I'm listening to is called 1929, and it's about the crash, right? The original crash. It's fascinating, right? Because
Is
it's
that
some of
the new
original.
Andrew Ross circuit?
Yes, yeah. It's awesome, right? Because it's to me at least, what I learned is how complete deregulation was one thing back then. Like there was no regs, and now, and some of the stuff grew out of that, out of the regulation of just some of the insider trading and all the stuff that was going on back then. But to me, yeah, I find it fascinating. Just probably some of the early banking laws that came out of it. Right. You're like, okay, now, you kind of listen to what's happening and how many times they go back and forth.
Right.
One of the bigger things I got out of it is even back then there were politics, right? Like even back then there were politics of what the Democrats wanted, what the Republicans were looking for and all that. So,
And it's really like the ebb and flow of compliance, right? Something bad happens, and then a lot of times we go overboard with the requirements that ensue, right? And then
right.
a few years later, we start looking at it like, what do we really intend to happen here? And try to dial things back a little bit.
Yeah, probably like a set of waves or something.
Exactly.
Well, good. No, that's great. All right, so let's go on to what the BBB does for, or what bankers maybe can talk to that might be relevant for their customers.
We'll be right back.
Ever feel like your tech budget's running the show instead of supporting it? You're not alone. Between bloated vendor contracts and outdated systems, a lot of banks are stuck paying more for less. And here's the kicker. Those big tech vendors, their contracts are built to protect them, not you. So if you're hesitating to make bold moves because of tech costs, it's time to flip the script. That's where Remedy Consulting comes in. We help banks take back control, cutting through the fine print, optimizing spend, and finding tech solutions that actually fuel growth. And we're offering a free review of your tech stack, spending, and vendor contracts. No pressure, no sales pitch, just expert insight to help you make smarter decisions. Even if we're not the right fit, you'll walk away with clarity and confidence. So go to remedyconsult.net or call 206-295-5776. Let's make your tech work for you, not against you. Thanks for listening to the BankTalk podcast.
Yeah, I think this is where it probably gets more relevant for the banks is probably educating their customers on what's changed and what's updated. I think from a commercial customer standpoint, we mentioned the bonus depreciation as well as the Section 179 expensing, and two concepts that have been around but were scheduled to phase out, and the amounts are getting increased. So that's always helpful and promotes capital investment. But another more significant one for a lot of commercial clients are research and development expense changes, where they're restoring and making permanent the immediate expensing of domestic research and development costs. So I think this is one of those ones that actually goes contra to the original Tax Cut and Jobs Act that were required businesses to amortize R&D costs over 5 years. And now, so for domestic R&D costs, businesses can now take that immediately. Small businesses can actually go back and amend prior returns if they felt that
Really?
that was worth enough. They have a deadline of July 4th of 2026 to do that. So certainly recommend any folks that see that through their financial statements. A lot of banks are in a unique situation where they get to see the financial statements of small businesses, and a lot of them use tax returns to support a lot of the numbers. So, something of value add that a financial institution can provide is saying, "Hey, talk to your tax accountant to see if it makes sense for you to go back and recoup some cash you already sent to the government." So each situation is going to be a little different, but everybody else can accelerate it over 25 or 26 as well. So this is where software, so commercial customers that are developing software is probably the most prevalent space. And certainly this applies to banks. We do see a lot of banks historically have not created their own software, but we do see them modifying a lot of software nowadays, and some actually creating their own in certain situations. So this will be helpful for them for sure.
Yeah, well, I mean, the nice thing about that is even if, like, I don't think we're recommending any banker go out there as a financial advisor or as a CPA, right? I think what the goal would be is for them to be able to go have the conversations and say, go talk to your financial institution or your CPA, your tax accountant, whomever, right? Your attorney.
100%.
Yeah, and see if there's something you can do. But if anything that frees cash flow and takes it out of the hands of the government, puts it back into the small business, I think is going to be a great conversation to have with them.
Yeah, definitely. And, more publicly, I think we've all seen the phase out of many of the clean energy tax credits, most notably the $7,500 credit on purchasing an EV that expired on September 30th. It'll be interesting to see how that plays out in the auto industry. I think I've heard more recently that Ford was halting production of electric trucks now. So it'll be interesting to see how that plays out in the industry and in sales. Obviously, that I did hear that I don't pay attention to the price of EVs day to day, but I have heard that some of them have slashed prices because the credit's gone. So it'll
Oh,
be
they had to
interesting to see.
slash them because they don't have a supplement anymore.
Yeah, they don't have the supplement, but it's yeah. So does the trend towards EVs not speed up or accelerate because of the lack of these credits, and those cars are a little more expensive to build?
Yeah. Were those credits, and if you don't know this answer, this isn't a quiz, but were those credits something that could be taken immediately by, and were they by the owner or were they to the manufacturer?
I think it depended on whether you leased the car or purchased the car.
Okay.
I feel like I'm not an expert in this area, but I feel like when you leased the car, the credit went back to
The owner?
the dealer, and
Sure.
when you purchased the car, you got a credit on your tax return.
Your tax return. Okay.
Yeah.
So the way the manufacturers would be using that is they see that as a supplement, right? Or a way to reduce the rate or something along those lines.
Yeah, I mean, ultimately, I think that gets them to be able to sell more cars, right?
Right. Right.
that
They gotta
now,
keep it competitive. Yeah.
yeah, and I think it's all depends on if the user is looking at a car and want to buy, we'll say, a Ford truck, and it's $55,000 versus a Ford EV truck and it's $70,000. What's the beta difference that I'll pay to get the electric vehicle versus the combustible engine?
Yeah. Excellent.
And I'm not sure the answer myself. I do not own an EV.
Yeah, I don't
It's
either.
certainly
And I've
something I think about, right? That what's the next car going to be? Is it going to be an EV? Is it going to be a hybrid? And when I'm an accountant by trade, so a lot of times the math needs to work a little bit anyway.
Yeah, sure. You got to make sure the math works. Yeah, absolutely.
Exactly.
Yeah, my wife bought an EV recently, and I like the model. I like the model of the concept of I think it's that hybrid. I'm sorry, she didn't buy an EV; she bought a hybrid, right? So a hybrid, more specifically, I think is a when you look at sort of the positives and negatives, I feel much better about that than just going straight EV for myself personally, because again, if you long road trips and all the we could probably debate this forever, but I think that concept of just start with a hybrid, make sure that we get that technology straightened out might make a little bit more sense in the short term.
100%. I do feel like it's probably an area where we need to figure out ways to continue to advance it. I had heard something on the radio a couple of months ago that made a lot of sense to me. They said that whoever was speaking said that if we already had EVs and we were converting to combustible engines, it would never work, right? If
Yeah.
trying to build up an infrastructure of gas stations across the country,
Oh yes,
and it's like
yeah,
dirty fuel, like it would never go the other direction, right? So it kind of makes you think that we sort of have to continue down this path of figuring out the best approach.
Yeah,
for
that's a
everybody.
great
Right.
perspective. Anything else that banks might be interested in talking to their business customers about, or their
Yeah, well, I think that probably covers most of the significant business customers. I mean, there is also some permanent increases in federal gift and estate tax exemptions that were expected to sunset. So I think a lot of commercial customers dealing with the future of transitioning their companies to the next generation and within a family business is certainly something that's relevant to them.
yeah,
But
so they've got to
we've
pay attention to the limits, and they're all changing, or
exactly.
changes going on there.
Yeah, and I think those are set to expire at the end of 2025. So you had a lot of folks already moving forward with some wealth transfer this year that now they can slow down if they really wanted to.
Gotcha.
On the
Okay, so
the
yeah, go ahead.
customer side, did you want to go through some of the individual stuff that is probably pretty important to a lot
Yeah,
of
if
folks?
you could hit maybe the top couple, yeah, that would be great.
Yeah. I mean, I think the one significant thing is the no tax on car loan interest. That there's a new benefit that allows certain taxpayers to deduct interest on qualified passenger vehicles, for years beginning after December 31st, 2024. So starting this year, that if you purchased a vehicle domestically made for personal use, you get to deduct the interest on your tax
Wow.
return.
Interesting.
is
I didn't even know that was there. Okay, that's awesome.
exactly.
Interesting.
And then increase in the state and local tax deduction was increased to 40,000, which will help a lot of folks. A lot of folks were the last few years were all of a sudden doing standard deductions because they were limited in the amount of state taxes they could deduct on their federal return. So you went back to making your tax return a little easier, but you're kind of losing that benefit on state and local income taxes.
So when they made the changes to the standardized deduction, right, and they
Right.
kind of said, here's some things that are in and out of scope for the standard deduction, and then we'll move the tax brackets. How did the state tax play into that?
So
Or how will it now?
if you were an itemized tax deductor in a state, I live in Massachusetts, and Massachusetts is they have a state income tax where we pay, I think it's 5.9% on our taxable wages in state income taxes. That was limited to $10,000 deduction on a federal return. Prior to that, so where it becomes an issue is basic math. So higher earners, after they paid the state more than $10,000, they still got a deduction for that payment on from their federal income, right? So they didn't have to pay the federal tax. And now the prior changes limited that to $10,000 cap. So if I paid Massachusetts, we'll say $30,000, I could only deduct $10,000 on my federal income tax return.
So did they just pull the entire cap off it?
So no, they didn't pull the cap off. They increased it to $40,000.
Oh, to 40.
So this is certainly impactful for a lot of states that have sizable state income taxes. So off the surface, you think of like California and the East Coast states of New York, New Jersey, Massachusetts, and certainly other states. I'm leaving some out, but those are
Wisconsin's one. We're in there as well, fortunately.
So just the limit on that. It changes the limit. So now your itemized deductions, you might have to itemize your deductions again to get the most bang for your buck now. So something that a lot of folks will have to look into again, but they might have stopped tracking some of their deductions because they weren't getting it the last couple of years.
Sure. Because I think mortgage interest was one of the original caps, and then there was something else, maybe real estate taxes.
Yeah, real estate. Yeah, those would be the big ones: the state real estate taxes and interest taxes.
Did all three of them, the other two, stay the same?
The real estate taxes stayed the same. They did make some caps on interest payments on home mortgages. That's up to 700. They made permanent the $750,000 cap. So any interest you're paying on anything over 750 does not get a deduction.
I gotcha. Okay.
But when you stack them all together, they become a pretty sizable deduction that was lost because of the limitation on the state and local income tax deductions.
Absolutely. Okay. Anything else in there that, just from an individual's perspective?
I think that there's so many little nuanced items in here. To everybody listening, I'd just say make sure we have some conversations with your tax accountant, whoever helps you in that world, to make sure you're filing correctly. I'm sure a lot of the more basic ones, if we're using a tax software like a TurboTax or something like that, I'm sure that'll ask new questions that maybe you're not used to seeing over the last couple of years.
Excellent. Okay, I wanted to hit briefly this conversation that I originally brought to you because I thought this was part of the big beautiful bill, but I think you corrected me to say no. This is really some of the stuff is executive order, but we'd heard a lot of conversation around the ability to add additional things into 401k plans. And I'm simplifying that. I'm sure I got the wrong terminology. But what popped out to me were things like private equity investments, crypto assets, maybe real estate. To me, when I heard those conversations, and you can tell that I'm not the most educated on this subject, but what occurred to me was, okay, if that goes into law immediately, how are the administrators of those plans going to deal with that? So if you could, number one, educate the audience on, was this part of the big beautiful bill? This concept of, I'm going to open it up from, basically stocks and bonds to things outside of that. And then and then from there, just give us your thoughts on how's that going to actually go from maybe a law or an exec order to reality?
Yeah, good question. The short answer is I think it's more referring to there was a Trump executive order in August entitled Democratizing Access to Alternative Investments for 401k Investors, which basically instructed the Secretary of Labor to to provide updated guidance on how folks could use alternative investments in defined contribution plans, such as a 401k. And I think on the surface, we all probably look at our own 401k and either are overwhelmed with the number of choices we have or are disappointed in the number of choices we have. That we're all over the spectrum on whether we're conservative in nature or aggressive in nature for our 401ks. So I think this is Trump's way of saying, "Hey, I want to allow everybody access to more investable assets that they want to invest in." I think so the Secretary of Labor has 180 days to come up with new guidance. But subsequent to that updated guidance, there's additional action that's required by the Treasury and the SEC to implement anything. So I think we're probably a few years away from being able to do anything along this way, but there are concerns. I mean, personally, I think of the defined contribution plans. Those 401ks are the primary source of retirement funding for most Americans these days, as defined pension plans become more extinct. And how much risk on do we want to add to these, and are there any soft landings that the government's going to have to put in place if folks choose to invest in, let's just say, crypto or real estate, and then by the time they retire, those markets can crash or change dramatically or didn't increase in value. So the plan administrators of the world certainly need a lot of guidance how they can do this in a fiduciary capacity for their clients. So, there's a lot of legal issues, I'm sure, that they need ironed out before they can start offering. And then when you do offer it, what's the form of it? Is it individual property that I put in there? Is it, some of these digital ETFs? You see the Bitcoin ETFs. Are we talking about those things, or can I put Bitcoin in? And how do we operationally deal with it? Some of these concerns. So I think we're a few years away, and we probably need to iron out some issues of what percentage of a portfolio could be in alternative investments, and because we still need to protect people from themselves sometimes, right?
Yeah, I would agree. Because I think as we talked about this in the pre-prep, right? The concern historically, or at least maybe just between the two of us, the concern would be I think I've just added riskier assets, right? Because as you know, crypto, if you look at what the life cycle or the how that thing goes up and the various cryptos go up and down, the individual Bitcoins of the world, right, go up and down. There's a lot of risk there. You look at, I don't know if you've ever seen a private equity offering, but I mean, you got to be fairly savvy to understand what you're buying and how you get in and out. Right.
Exactly.
So that's, so that's a risk. And same thing with just real estate, right? But, if all of a sudden I let John go buy a property somewhere in the middle of Florida, who knows, what does John know about Florida property, right? I mean, so for you to put too many of your assets into that type of a thing and then potentially lose them, and now not have Social Security, nobody's got a pension anymore, right? We're putting a lot of things at risk by not putting some guardrails around this, if that's the right term.
Exactly, 100%. I mean, I think more recently with Bitcoin in particular, you don't see as much talk about it being a store of value, do you?
Right. Yeah. As it moves up and down, right? One minute it is, and the next minute it really isn't, right?
But I like the discussions and the advancement of opportunities for what we can invest in our 401ks, but we certainly need to make sure we have a lot of guardrails in place.
Yeah, absolutely, absolutely. Because
so
some
that
people would never be able to
that
get
would,
into it otherwise, right? I mean, so
right,
there is certainly an upside benefit to it as well, is that you got to let people use their money.
right,
Right.
and ultimately, if something super tragic were to occur, we're all going to be left holding the bill somehow.
Absolutely. Well, John, thank you. I really appreciate your input. It's been great. Anything else we missed?
Yeah, no, I think for the most part, I think I already said it a little bit, but the bill is exceptionally broad and nuanced. All of the listeners should be consulting with their tax advisors and how it can and will impact your business. For us, generally speaking, we try to have a tax planning meeting with all of our clients prior to the end of the year, so that if something needs to be actionable before 12/31, it can be actioned on in advance. So and every client is a unique situation of, hey, maybe bonus depreciation doesn't work because earnings aren't as strong this year. So why would I want to take additional expense on a tax return when it's going to push me possibly into a taxable loss? So there's a lot of moving parts to consider when you're taking some of these strategies. And if you can best use them later on, and you try to do that when you have to.
Yeah. And again, I think the listeners probably appreciate the fact that if nothing else, right, I'm sure that within their bank or credit union, they've probably got folks that think about these things all day long, but just some things to talk to their customers about, I think are help make it.
Yeah,
We're always trying to make banking relevant to the real world and make sure that you're speaking the public's language. So I think this has been great that way.
Yeah, and then a lot of takeaways, similar takeaway that you just said. Like, I'm always trying to add value to my clients, and my clients are always trying to add value to their clients, right? So, educating them on some of the more important pieces is always a good strategy.
Excellent. Well, John, thank you for joining us on Bank Talk. Really
Uh,
appreciate your input.
All right, Charlie, it's a great time. Appreciate it.
That's all for Bank Talk. Appreciate everybody listening in today. Have a good day and keep on learning.
Thank you for joining us on the Bank Talk podcast, brought to you by Remedy Consulting. If you enjoyed today's conversation, please rate, review, and share our work with others. To stay up to date with future episodes, be sure to follow the show and turn on notifications. Thanks again, and we'll see you next time.